Hello and welcome to the Economic View. A little bit different this week. We're actually going to sit here and talk about something that is very close to most of our homes, which is home loans. And that's why I've got Tony here to talk about the real estate side, and I'm going to talk about the macro side, about what's currently going on in that space. And let's start with the article that you brought out this week that was written by our articles by Gemma. It's very interesting at the moment. We've been talking about this in the Economic View for a while around rate rises. What you did this week was obviously look at it from the actual consumer side, from the mortgage holder side. What have you found, particularly with rate tweaks and rate movements on the retail side rather than on the actual institutional side?
Okay, so the interesting thing is that the Reserve Bank has held their rates for 21 months now, but what's been going on the retail side is that banks and other lenders have been ratcheting up various loans quite extensively. We've had more than 500 adjustments this year so far, which is a huge number, and they're across variable and fixed loans. So it's really a different picture, and despite the Reserve Bank holding rates, that's not the case on the retail level.
Question therefore is, when you hear about that, and we've been talking about this before, is about the tweaking, you poke to the point that it's the fixed and the variable. Are they targeting certain parts of the market? Is it the lenders? Is it interest only? Or is it, principal interest only loans as well? Because listening to the media and listening to what we've been speaking about, they've been trying to sort of reduce risk by pushing particularly interest only loans towards P&I. Is that what you found, or is it actually almost blanket across the board?
Well, yeah, it's quite interesting. The data we commissioned from CanStar shows that there's been adjustments right across the board. So variable rates, principal and interest, owner-occupied loans, some of those have been increased, some of them have been adjusted downwards. It's largely about competition in that area. Fixed loans have been going up, probably more extensively than going down, and again that's reflecting the competition in the marketplace.
That's interesting that you raised the competition point, because we are now going through bank earnings season. So we've had one as of today, and that was ANZ. From my side, and what we look at here, is the macro stuff is actually starting to hit them as well. So they were very prominent yesterday that if all things remain equal, for stuff that we've been talking in the Economic View for probably the last 6 to 8 weeks, which is the bank bill swap rate 90 days and 30 days, that's the chart I've put on screen for you right now. If it was to remain at those elevated levels that you can see, the second half of their financial year will be hit. And that is what they're now alluding to. So it gets back to your point around why you're seeing the retail side. We've also saw over the last 24, 48 hours, the Reserve Bank's entrance, and you've already alluded to that this morning. The interesting thing listening to both what's coming out of Philip Lowe and out of the statement is that they are very clearly saying that rates are unlikely to move now to, at the earliest, in our opinion anyway, the back end of 2019. Some are even saying 2020. But what they are alluding to is this tightening in the money market and credit market cycle. And they are very aware that this is starting to actually create a bit of a crunch. And then you've got the Banking Royal Commission, which is likely to see increased lending standards again. So the macro side is also supporting what you're saying, which is that the banks are having to find this happy equilibrium, trying to make sure that margins remain robust and also still, conducive for shareholders, but without pushing their actual mortgage holders to the next level. So I found that quite interesting as well. Other part of your article that I found quite interesting is, again, the reasoning behind it was obviously what you've alluded to, but I found it quite interesting that, again, the comparable rates and the actual rates are, again, differing, and it's a product thing as well. Did you find anything interesting between whether it's the big four or whether it's the smaller side of the banks? Anything there that also caught your attention?
Well, the big four have definitely been very active in terms of adjusting their rates across multiple products. And you've got to keep in mind that there's literally hundreds and hundreds of products out there which investors and owner-occupiers have got access to. So it's across the board, but I think funding costs definitely do come into play, Evan, and we're going to see more of that. But what's interesting is that we've also had the data out just now on softening house prices. So it's going to be quite an interesting interplay between housing prices softening, pretty much on a national level. Then at the same time, we've got rates creeping up across many different areas, and then we've got the Reserve Bank, in its holding pattern.
Well, with that, we're going to leave it there for this week's Economic Review. Remember, next week it is the budget, so we'll have a special showing of that. If you do enjoy the Economic Review, please write into us. We always like your feedback and do very much enjoy hearing what you have to say.
Thanks for joining us.